Marc Franklin is Deputy Head of Multi-Asset Solutions Asia at Manulife Investments. Thank you very much for joining us, Marc. Prashant here. Would you agree with Mr. Dalio? And for investors or traders in the market now, are there any near-term implications? Will bond markets throw another tantrum anytime soon, do you think, that with fiscal risks looming?
Good morning. Well, if you look at the CBO, the Budgetary Office projections in the US, and then you layer on top of that the intentional spending and tax items that the Trump administration is attempting to pass through Congress, it does result in a further widening of the fiscal deficit from an already elevated level, and in absolute terms to a high level in the context of it being somewhat of a pro-cyclical fiscal policy setting. So there's definitely a question mark over the long-term sustainability of that path and the extent to which investors in US bonds will be willing to invest at current yield levels. Now, with respect to whether that will lead to another resumed bout of volatility in the bond market, don't forget we've already had a fairly pronounced steepening of the bond curve in the US and rising term premium. But the front end of the US Treasury markets, all the way up actually to the 5-year point, have been quite well anchored and pretty well bid by investors in the US Treasury market. And so what you're likely to see is a potential further steepening of the curve, but it's also dependent on the extent to which the economic data in the US follows a path of some kind of softening, because that will allow front-end rates to remain anchored and allow the market to continue to expect some rate cuts, which will also further steepen the curve. So it's not just about the fiscal path, which we would concede does raise questions, but it's also the development of the economic data and how that progresses in the coming months as well, because any sniff of a slowdown in growth, you could in fact see a resumed bid for bonds, given that the US 10-year up until the last couple of days was trading at a pretty interesting 4.5 to 4.6% level in yield terms.
Marc, hi. And, we've started seeing some evidence when yesterday's private sector payrolls report was quite weak. Let's see what the actual U.S. jobs report, showcases on Friday. But my question is this. Would you think that the direction in the near term for equity markets is still higher despite all this? Because even if data is weak, perhaps the Fed starts cutting. In any case, whether this is the big, beautiful bill or the big, ugly bill, as now Mr. Musk is calling it, the fact is it's adding a lot of liquidity in the markets. Generally, tax cuts, I mean, they're good for consumption, aren't they?
Many moving parts at the moment. Let's try and take some of those in turn. The first moving part is that we've had a very pronounced rebound in equity markets, a welcome rebound in global equity markets. And the rebound to some extent has been led by US equities, given that they had lagged the rest of the world for the first 3.5 months of the year. So we're at a point now where valuation multiples, to some extent, have priced in a fairly relaxed stance and expectation with respect to the outlook for tariff, trade policy and dynamics amongst trade partners with the US. So there's a certain degree of comfort that's now priced back into markets. That may well get tested as we approach that expiry of that 90-day pause in early July. But at the same time, the corporate earnings cycle and the share buyback cycle remains pretty solid, and the earnings seasons have come through just fine. And so from a fundamental perspective, if you take a snapshot now, there are reasons to remain constructive on risk assets. But going back to other moving parts as well, you mentioned liquidity injections into the markets. If you look at the US Federal Reserve and real yields, which is effectively a proxy for financial conditions, the Fed is running a relatively restrictive policy stance on the monetary policy side at the moment, not just in rate terms and real yield terms, but also in terms of balance sheet. The balance sheet continues to grind low and bonds allowing to be run off. And so it's really up to the fiscal side to offset that, and in some senses to inject fresh liquidity into markets. And there's another moving part as well. Whilst the House of Representatives passed the BBB bill, the Trump administration bill, it's now being run through the Senate, and there are definitely some voices reflecting the prospect that some amendments will be introduced to that bill, which will force it back to the House again. And the equity markets, but also the bond markets, will start to address probabilities of easy passage or amendment type passage and the extent to which that can be done quickly. And that will then lead to some marginal shifts in appetite for risk assets versus more defensive assets. So many moving parts at the moment. We've had a pronounced rebound. You can see a reason why equity markets can hold in at these levels if a certain set of things prevail. But you can also see as we approach the late summer months into July because of the tariff policy uncertainty, some investors may look to take some profit after this pretty sharp rebound as well.
All right. Hi, Marc. Good morning. Good to see you. Ben, Nigel on this side. I think you were overweight Asian equities. Do you hold onto that stance? And also, where does India fit in? The problem for India is that valuations seem to be restricting the flows that are coming into India. However, if you're looking at growth, then India is top of the ranking, right? So your approach to Asian equities, and where does India come in the pecking order?
Yeah, so our broader top-down view is we want a diversified global equities portfolio, which means not being quite at benchmark weights for US equities because the benchmark weight is so high, and using that sort of lightened up position to invest in more discounted markets from a valuation perspective, where the risk reward and the risk premium are somewhat more attractive. And that includes Asia as well. So we are fully invested in Asia at the moment, but within that, we're taking a somewhat selective stance. So you mentioned India. You're right to point out that the absolute trajectory for growth is region leading, but to some extent that's discounted in valuations. The RBI's room to start cutting rates again should provide some kind of support for the cyclical growth outlook, and the extent to which that can drive a re-acceleration of bank loan growth. But if we take a step back on India, one of the challenges for the Indian equity market is because it's seen as a quality growth exposure where regional and global allocators feel comfortable over strategic time horizons to be fully invested in India, it kind of serves as an ATM, a source of funds when investors want to take more tactical, shorter-term, longer positions in markets which present an interesting setup. And I give you an example of Korea. We've just had the election there, a pretty clear outcome which reduces policy uncertainty, and it brings investors back into focus for the Korean market after a period of time where they've been on the sidelines because of political uncertainty. And India is a source of funds as people want to redeploy a bit more money into the likes of the Korean equity market, and early this year in the Hong Kong, China equity market as well. So India is sort of the core holding, but it sometimes gets used as a source of funds for investors to broaden out their exposure within an Asia context as well.
That's an interesting point. I mean, kind of explains, at least in part, why foreign flows have been very patchy into the Indian market. We mostly get very positive feedback on the narrative and the growth potential, but the money flow has been a little patchy. All right, Marc, thank you very much for the perspective. Thank you for joining in today. You have a good rest of the day, and we look forward to the next call.